that premise of how I go into the marketplace and what I'm looking for on the weekend, usually either on a late Friday evening once my whole family goes to bed and they've turned down for the night. I don't sleep like a normal person. So I do a lot of study really, really late in the night or early in the morning before they wake up. Or if I don't get that, I do it on a Saturday. I look at the weekly chart in reference to a monthly chart, a 3-month chart, a yearly chart, and I'm looking at it the same way I'm doing here. Okay. And I'm trying not to steal too much thunder from future lessons, but just know that what I'm doing here, I'm done that with a monthly chart. I do it with a 3-month chart. And on TradingView, it's really nice because if you go in, if you type 1M, it takes you into a monthly chart just like that. And right away, you can see things that you may not have noticed before. So you have a 1-month chart here, and right away, my long-term students can see right away, they're thinking, wow, that thing used the volume imbalance right there. The separation between this body's close and this body's open. That monthly candle went right up into it there and then went lower all month. So I'm looking at those types of relationships. And you can look at 3M. It'll give you 3 months of data. You can see how we're drawing down into this buy side imbalance, sell side inefficiency, which is the same thing I just highlighted in purple on the weekly chart. That's this here. It's the same thing. So in my mind, I like to look for those first. And if there is no inefficiency, then I'm looking for liquidity. So in summary, let me rephrase everything I just said. When I sit down on the weekends, whatever time I'm going to be doing my analysis, the market is not trading. All of my analysis is done when the market is not trading. What I'm trying to predict, to anticipate, not react to, what I'm trying to predict and or anticipate is where is the present weekly candle reaching for higher or lower prices. If I see an inefficiency like this right here, that purple shaded area, I'm expecting price to try to draw down into that. If this inefficiency wasn't there, I would look for that low because that's where sell side would reside. Or consequent encroachment, which is the midpoint of this candle's tail. So it would be this. Let me make sure I have my cursor sitting here for a second before I start saying anything more. I would either look for that midpoint of that candle's tail, which is consequent encroachment, or I would use the low of that wick there. If, folks, listen, if there was no inefficiency that's shaded in purple, if that wasn't there, I would be expecting price to draw down. Now, why would I expect that? What makes me say that? Because we already hit our targets that I covered in the previous weeks. For those that weren't here, I was talking about how dollar was going to go higher, that we were going to use this shaded area here as an inversion fair value gap, and it would treat it as something bullish to trade up into the weekly order block, which is this opening price of this candle here. This candle's opening price, that's the weekly bearish order block. It was acting as a target. Then I said the mean threshold of that candle, which is the middle point of its body in here. That's the bearish order block mean threshold. That was also a target. So once it hit that, we wanted to see what's going to happen. Once a target's met, whether for the week or a day, you have to get comfortable, grow real comfortable with just simply sitting still and waiting. Move very, very slowly when you're trying to make money. And I learned this lesson from Larry Williams. It didn't make any sense when I first learned it or heard him say it, and it took dozens of times of blowing out accounts, not listening to that advice. But you take all this information from a higher time frame, I do this, and I look at where price is likely to go. It's only going to go up for one of two reasons, okay? Price delivery continuum is the movement from where price is right now to future delivery. So where it's going to be 5 minutes from now, a week from now, 2 days from now, 2 sessions from now. It's going up to take out buy stops, or it's going up to trade into some kind of inefficiency, like a fair value gap. That is it. That's the only two reasons why price goes up, period. It's not buying pressure. I'm sorry, but that's the truth. It does not go up because of buying pressure. It doesn't matter how many people buy it. Perfect excuse is if you look at price and study volume. Okay? Study volume. How many contracts does it take for a limit up move in wheat? Not that you probably trade wheat. You only need one contract traded. It opens up at a limit up move, boom. Who can trade there? Nobody. It's lock limit. What was the volume? Whatever that trade was that marked it. That wasn't buying pressure. That wasn't buying pressure. It was only one transaction. It opened it up there, boom. Nobody else can buy it. That's not buying pressure, right? So that was the biggest wake up call to me when I was a commodity trader in the 90s. That's how I started, by the way. I realized that volume is important. Yes, it does have a place in analysis, but too much emphasis is placed on that as the reason why price goes up or down, and it's not. Price goes up to seek liquidity. And if it's going up, what liquidity is that? Buy side liquidity, buy stops. Okay. If it doesn't run for liquidity on that particular time frame, it's going up for an inefficiency. That means a gap. A gap would be like that purple shaded area here, or this. I don't know what that color would be called. We'll call it a pale orange. That gap between this candle's low, that candle's low over here, and this candle's high. That's what's being shown here in that little pale orange shaded area that's noted as the weekly inversion fair value gap. That gap and this purple one here, they are called inefficiencies. Think about the paint analogy I gave you. When price is moving back and forth in a defined range, what's the defined range here? Where your eye looks at price, just like I have it shaded here in pink, price has moved rather efficiently inside that pink area, up and down. Okay. When price entered the low end of this pink shaded area, now we don't know that pink shaded area is the range yet. What I'm saying is when I'm looking at price, I'm looking at how price was delivered during a period of time in whatever time frame I'm looking at. So this is applicable to whatever time frame you're looking at, whether it be a weekly chart, a daily chart, 4-hour chart, 6-hour chart, 15-minute chart, a second chart. It doesn't matter. Okay, it does not matter. What matters is where are the inefficiencies and where are the stops? Above old highs is buy side or buy stops. Below old lows is sell stops or sell side liquidity. Those are the two things I'm looking for after my eye goes through the chart and I'm looking for the inefficiencies. So the first thing I'm looking for is inefficiencies. That's the first thing I'm looking for because that's the array that the algorithm reaches for first. It pans for any inefficiency. If there's no inefficiency and we're in a premium and we're likely to go lower, then it's going to be looking for sell side. Reverse that. If we are in a range and we're in a discount and there is no inefficiency above price, but there's a short-term high, it's going to run for the buy side. That's what I'm doing on the weekly chart. So for the folks that are hammering themselves and beating themselves up, please teach bias. I just did. But what you're wrestling with is you don't have time looking at charts like I'm showing you here. You see this pink shaded area? How the market entered it, went up to this candle's high. The next week we opened up here. Then we traded higher up to this point here. Then the next candle or next week we trade down and overlap all the way and into the previous high. So there is no fair value gap formation whatsoever in the candle I'm highlighting right now. Notice that? The candle to the left of it's high and the candle to the right of it's low. There is no separation like you see in that purple shaded range. That's a fair value gap. There is no fair value gap between the candle I'm highlighting here with my cursor using the candle to the left and the candle to the right. So what is actually happening there? The price has gone up and down, up and down. That's like that wall being painted very efficiently. Is there any inefficiency there? No. So at that time, when we start on this week, we open, we rally up, make the high, and then we close after making a low here. So there's been a lot of delivery up and down in between the range high of this week and the close of this candle here. Now, why am I picking that close? It's because I'm showing you how prices reacted in here and why I was telling you on the 13th in a live stream that can't be cherry picked. It was told to everybody watching it that I want to see dollar reach lower. Okay. And we haven't even got off the weekly chart yet. I'm teaching what I'm looking at. And this is what I'm trying to tell you. I spend the majority of my time on the weekly chart. I'm looking at how price delivered. Think about what I'm showing you here and how that relates to this area right over here. Think about that right in here. That same idea, we can apply it to over here. I promise you, I'm taking you somewhere. Even though if you think you don't know what your understanding and confusion is probably peaking right now, just keep staying with it. I promise it'll make sense as I'm going. Same thing here. Price opens up, trades higher, back and forth delivery, all up to the high, back and forth, and then we leave it. So before this broke down, is there any inefficiency over here? Below this pink shade there, is there any inefficiency? Inefficiency would be like this candle here. How it has that separation between the candle's high to the left of it and the candle's low to the right of it. Does that occur or form anywhere underneath this pink shaded area in all of this? Do you see that? Yes. Right here. I'm just going to use a short little trend line. I promise you folks, this is the stuff you're looking for. Even though you may not feel like it's important right now or it doesn't make any sense, I'm going to take you light years ahead. Most of everybody else out there today. So there's a gap there. So I would take like this rectangle here. I would highlight this, but I'm only showing it as a small little section with the rectangle not being here, but just simply using the trend line sections. So we have an inefficiency here. So when the market leaves this range, it's in a premium relative to the low and where it traded to. It's in this range consolidating, and then it leaves it. Where's it going to go? Well, there's several things. You can use the consequent encroachment of this wick, midpoint of that. Then you have the gap here that this traded down into, but left the majority of the gap still untouched, right? So when it drops here, price is going to want to trade into this area here. Does it do so? Yes. And again, that would be bias. That would be bias for that particular week for the dollar. What do you think that would mean for you Forex traders that want to trade pound dollar? What would you anticipate that week? This week I'm highlighting right here. How would you use that information? You would go into your charts and back test any long positions during the London Open between 2 o'clock and 5 o'clock in the morning, New York local time. You would look at your AM session kill zone, the New York kill zone, between 7 o'clock in the morning and 9 o'clock New York local time. You would look for the model 2022. You would look for optimal trade entries. You could look for silver bullets because silver bullets form in the kill zones between 7 o'clock and 9 o'clock. Ooh, what'd I say? Yep, we're teaching that again today too. It's not limited to just index futures and 10 o'clock to 11 or 2 o'clock to 3 o'clock in the afternoon for index futures. If you're a Forex trader, everything that I teach is applicable. Even though you see me predominantly teaching it in E-mini S&P and futures contracts, it's applicable to Forex. You just, there's subtle little rules that you have to worry about, and time is the factor that's got to be considered. Because yes, there are silver bullets between 10 o'clock and 11 o'clock in Forex, yes, but they are really good ones between the 7 o'clock and 9 o'clock New York Open kill zone, and between 3 o'clock and 5 o'clock London Open kill zone. They're there every day. Every single day, you have a reason for you to find a setup. Now, again, that is not an invitation for you to go in and try to trade every single day. Okay? So I want you to think about how the market moves in these ranges. This is a balanced price range. Why is that a balanced price range? Because the market has moved up and down within it, and then it left the range. So if it's going to leave the range, what is the algorithm? Let's make an argument for the sake of folks that don't want to believe there's an algorithm that controls price and there's no amount of buying and selling pressure that's going to change that. Market's going to go where the market's going to go. It's predetermined. Your daily high and low is predetermined. Whether you like it or not, it is what it is, okay? How can we determine where that likely higher low is going to form, or where would it likely reach to? Starting on these higher time frame weekly charts. And if we know that we can see prices likely to want to expand lower, think about it, because we're on what chart, what time frame up here? Weekly. So my analysis, everything that I'm doing on the weekend, when the markets are not trading, I'm trying to determine what's the strongest directional bias that can be derived by looking at the weekly chart. What is it likely to be reaching for on a weekly candlestick chart? It's going to either be reaching up for buy stops, or it's going to be reaching up for a fair value gap above where the market is right now. If it's likely to go lower, then I believe it's going down to a fair value gap below current market price, or it's going to go down to reach for sell side liquidity below some old low. That is not complicated, folks. These things on your chart, they're not hiding from you. They've been in plain sight. You just never been told to look at it this way because you're trying to apply indicators and all these things. And frankly, when you look at it like this, you should be able to see it really quick. See, when I'm looking at the chart like this, my eye jumps real quick to inefficiencies. My eye jumps to that. My eye jumped to that. That. I'm probably moving faster than the live stream can keep up. And then obviously the gap that I just showed. And every high, every weekly candlestick, high and low, is a factor as well. They're going to be used again. They don't just get used one time and they expire. Okay, so I teach there's a 60-day look back, and the highest form of precision or highest form of accuracy in terms of my key levels, I define it within that 60-day range, and it's 60 market days, not 60 calendar days, obviously, but it's looking back 60 days. So what I'm looking for is the highest high and the lowest low in the last 60 days. I'm looking for inefficiencies in the last 60 days, whether it be premium or discount. That means a fair value gap like that purple one here was. Before we traded down here, in the beginning of the week, the dollar index was up here. And on the 13th, I explained it. I felt like we would draw down. I'm teaching the part that was not made available to you on the 13th live stream. Okay, so I'm filling in that gap of insight that wasn't made available in that presentation, but this is the logic that went behind it. So let me take this off and we'll drop down finally into a daily chart. Okay, so here's the daily chart, and let me take all this business off because they're all distractions, and I want you to focus only on the things that I'm making a point about. All right, so this inversion fair value gap was an old gap. Notice that it does not look like a gap on the daily chart, where it did look like it on a weekly. Let me just, for completeness sake, drop back up to a weekly chart. That separation from this candle's low and that candle's high, the candle to the left of that, it's only sell side delivery. It's a sell side imbalance, buy side inefficiency, SIBI, S-I-B-I. It's a fair value gap, but the classification is a SIBI, meaning that some future time the market is going to trade up and deliver price on the upside. So it's offering buy side delivery. We see that happen here on this candle. But I said that we would treat that as an inversion fair value gap. Go back and look at all the presentations and commentary around that at the time. But on the 13th of this week, June 13th, 2023, I said that we would look for this old gap. Okay, this is what separates me from folks like Chris Laurie, where they look at an inefficiency and then he'll tell you it's done. That's his terms. It's done. It's not meant to be disrespectful, but when I tell people you can learn how to read price action with Chris Laurie, if you don't like me, that's fine. But you won't learn what I'm teaching from Chris Laurie. But you can learn how to see inefficiency in price. I didn't learn inefficiency from Chris Laurie. Okay, I was trading before Chris Laurie. But long story short, this whole business of inefficiencies, we can use them as real dynamic support and resistance, because that's in fact really how the algorithm refers back to them. Meaning this, when I look at this range, this shaded area, it doesn't look like a fair value gap on the daily chart, whereas that is a fair value gap. You see that right there? Look where I have my cursor at right here. On this candle here, go up. That candle I'm laying my cursor on top of, to the left of it, that candle's low here. And the next candle to the right of this one, that candle's high, that is a fair value gap. It is a SIBI, sell side imbalance, buy side inefficiency. Notice that that is not what you see inside of the shaded area here. That was the weekly inversion fair value gap. So the price delivery continuum is when you have these higher time frame inefficiencies, regardless of whatever time frame it is, in this little area right here. Okay, I'm going to just draw one more rectangle because that way you can see our frame of reference. This high down to present market right there. Okay, that shaded area here is this candle underneath my cursor. That day, which is the 12th, from the 12th, and then the 13th is when I gave you the analysis. Okay, I told you it's a live stream. It was not a pre-recorded video. I told you I want to see it. Treat that weekly inversion fair value gap, which is this one here, which is anchored on a weekly candlestick chart. Right now, we're looking at a daily chart. You can track that by looking up here. So the 1 day is a daily. So in this range here, in my mind, I was seeing this delivery of price. This is what I'm anticipating. This is what I'm predicting. I'm not reacting to price. Okay, I see this forming and I'm articulating that in the live stream of June 13th, 2023. So because I have this range now shaded, when we drop down to the 60-minute chart, inside this area here, and I want to scrub that little rectangle over to the 13th, and that would be the perspective. Okay, so what we're looking for is in this area here, did, true or false, folks, okay, you're judging me now. I put out my expectation. I anticipated in this time here, before we closed the week, I said later in the week, going into Thursday and Friday, I believe, and I say this in the 13th live stream for the dollar index, I believe that we will likely draw down into this order block, which is that level right there, 102.705, right there. So I'm going to take this box off here so now we can see that. So this is where we're looking at. Did it use, whether you believe there's an algorithm or not, okay, did price use this shaded area as a means to dig into, go up into, and then repel it lower? I mean, I think there's sufficient evidence to suggest that what I was outlining and anticipating, price is doing that, is it not? It did it here. What time of day is that? Look at the bottom of the chart. That's Wednesday, June 14th, 2 a.m. What time of day is that in terms of ICT kill zones? That is the London Open kill zone. That's 2 o'clock in the morning to 5 o'clock in the morning, New York local time. Every single time you look at your time references, it's always in New York local time. I don't care where you live. It's no disrespect to you or where you're at, but the algorithm runs on New York time. The day, the trading day, is not defined by Wellington, New Zealand. Okay, I don't know where this idea came from, but it's straight up New York local time. That's the way it is. Okay, so everything runs on that. And if you keep your time relative to New York, and when your trading view set up here, you can see it's always set to New York. If you do that, you'll know when to anticipate. When to anticipate. When do these moves form? When do they begin? Where do the highs and the lows of the sessions begin and end? Within those time windows I've given you. Now, by itself, just knowing that the high or low of a market in Forex forms in the London session between 2 o'clock and 5 o'clock in the morning, that in itself is a huge advantage. Because if you can have a weekly bias determining that, okay, if we suspect that the dollar index is going to be bearish for the week to come, and forget the economic calendar for a moment because we're going to get into that too. If we think that the price is likely to draw down into these levels here, now I'm going to take that purple shaded area off because that's the weekly fair value gap that I did not mention, but I didn't need to because I took your attention right to that level there, which is the daily bullish order block. A daily bullish order block doesn't always mean it's an entry to go long. It's a draw on liquidity. Okay, it's a PD array that the market will want to reach into. Obviously, you can see that that order block did in fact cause a nice little run up. Where to go up into? Look closely. Where to go into? That same shaded area, that old weekly fair value gap, the inversion fair value gap, dimensioning of it being used as what? Resistance. So in here, we're talking about it. It's likely to go up. We're going to see it treated as resistance. Does it? Yes. Does it go down to the level I talked about on the 13th as a draw on liquidity or target? Yes. Then what does it do? It repels price higher again. And it goes into what? Look at these three up close candles right in here. See all that? Listen close. ICT, why do you use the last candle on some examples and other times you use the consecutive candles? Well, all of these are inside of this fair value gap, that shaded area, which is an old weekly fair value gap. If they're consecutive like this and they're inside that range, I'm going to use the entirety of all of that because the beginning of this opening on this candle here and the next candle and the next candle, that's all one price delivery for buy side. It's delivering buy side delivery. So that means there's movement up. So I want to refer back to that opening price right there because that starts the order block. And the mean threshold would be the middle of the low of this candle to the high of that one. And that would look like this. So we have the low of this candle up to the high. Mean threshold is 103.324. Okay. So we allow, listen folks, we allow for price to trade to and through, but not close, listen, not close above mean threshold. So the wicks do the damage, the bodies tell you the story. Look what's going on over here. See all that? We'll get to that in a second. Opening price, let me drop this here. It hits differently when you know I've already talked about it beforehand, huh? Oh man, I can't use a cherry picking analogy on it now. So here's the mean threshold, so that's what I'm identifying here. But this level, that opening price, there. That is the change in the state of delivery. Meaning, on the 13th of June, I stated that I want to see, you want to study, if I have any validity behind these things, if it's not going to hold up, if it doesn't react the way I'm talking about in the future, then there is no algorithm. That means that I'm a fraud. That means that there's none of these things should be even studied because it's all hindsight. Okay. So what I do is I tell you in the analysis where I think price is going to gravitate to. And then you as the student, you go back through price action and you look for what PD array you like. What does that mean? What's that mean? What do you use for your setup? What's your multiplier? Is it the optimal trade entry? Is that what you use to get into a trade? Do you use a fair value gap now? Do you use the 2022 model as your trade? Do you use breakers? It depends on what you feel comfortable trading with. There is no better PD array than another one, because not every single price run will have every single one of my PD arrays in it. Not every single price move that I'm trading has a breaker in it. Not every single one of the trades I'm entering is using a fair value gap. Not all of them are an order block entry. Not all of them. Well, when's the last time you see me talk about an optimal trade entry? But you probably still trade them, right? I'm teaching you a wide spectrum of opportunities for you as the trader to gravitate to whichever one makes the most sense to you. All of them are equally profitable. All of them are equally capable of blowing your account if you misuse them. These consecutive up-close candles is one order block, meaning that inside this shaded area, right before this market changed and went lower, my eye goes right to that opening price because I'm using all three of these candlesticks because it's inside of a range. I've already told you on the 13th, we want to treat that range as a inversion fair value gap. In other words, it's an area where the algorithm will go up, spend some time in there, allowing smart money, traders that will see what I'm teaching you that isn't in books. They're using this frame of reference because they want to sell short here and buy at a lower price down where the order block is here. An order block is not orders. You can't see an order block the way I'm telling you. You can't see that on level 2. There's people that say, oh, level. It's not level 2. It has nothing to do with the orders. It has nothing to do with it. Nothing. Okay? So stop the bullshit. It's where the market changes its state of delivery, meaning that inside this shaded area, we want to see the price go up into it. Does it do it? Yes. And then once this candle's opening price, that is the beginning of these 3 consecutive candles, and I'm using all 3 because it's inside the area I told you to define as the reason to anticipate price going lower from the beginning, right? On the 13th of June, I said, we want to see signatures. That means evidence in price delivery, in price action itself. Does price show a willingness to treat this shaded area as resistance? Does it want to send price lower when it enters into it? Where? The low, midpoint, consequent encroachment, and the high. We don't want to see the high end of an old fair value gap if it's being treated as an inversion fair value gap. The better setups form if the high, if you're looking at it as a resistance or using it as the beginning point or inception of a sell side delivery or sell program, we don't want to see the high traded to. Treat that like the same thing I treat a breakaway gap, which is a fair value gap that won't completely fill in. If it gives you that signature, which is what we're seeing here, as soon as price breaks below the opening price here and leaves the shaded area that's in like a pale orange, once it does that, that qualifies that right there as a bearish order block. Why? Because the state of delivery changes from buy side delivery, then it crosses over the opening price there. Just because it crossed below an opening price of a series of up close candles doesn't make it an order block. The narrative behind where that order block resides, that is the imperative point that everybody is missing. That's why everybody that has books and bullshit out there they want to call mentorships and courses talking about this is an order block. You have no idea. You're making shit up. You're making it up as you go. You're on the fly. You're looking at something in hindsight, trying to explain something. In this shaded area is what I told you to look at it on the 13th. And then we look for signatures inside that range. What does that mean? Well, you have an order block here. You also have a breaker. What? There's a breaker there. High, low, higher high. Consecutive down close candles. Same thing we're applying here. All these ranges here, push it forward in time. You're getting the same entry here. Stop above here. We're not trading the dollar index, but I'm trying to tell you that you can pick your own model, and every one of you can be trading differently using what I've taught, and you're all can find profitability. You don't need the same entries. The entries are the least important thing. I'm going to say it again. Where you enter is the least important factor in consistency. It is the least important thing. You have to know this. Where is it going? Because if you can determine where it's likely to go to, and what I've outlined here in this beginning of this presentation today, you can find a myriad of entry points